Next, let's take a look at structuring a takeover deal. Financial aspects. There are three main financial aspects of structuring an acquisition. Deciding whether to bid for the target company's assets or for the target company's stock. The purchase consideration, that is the form the purchase price should take. The financing package to provide the purchase consideration. Assets or stocks. In a negotiated takeover, the buyer and the vendor must reach an agreement on whether the buyer will acquire a company's stocks or just specified assets and liabilities. When a target company's stocks are purchased, the acquirer obtains all the company's rights, liabilities, and contingent liabilities. By negotiating to buy specified assets of a company, a purchaser can be selective about which assets and liabilities to acquire. Tax implications. When the purchaser buys the entire company, the purchased company's tax relief details are also acquired. The purchaser will take on the acquired company's tax liabilities as well. Any capital gain is taxable, attributed to the individual shareholders of the vendor company and not to the vendor company itself. The purchase consideration. The purchase price of an acquired company could be in the form of cash, paper, a mixture of cash and paper, a choice between cash or paper as preferred by individual stockholders. Click here to see each one in detail. The purchase consideration. Cash offers. When a company has sufficient cash to pay the purchase price in full, a takeover usually can be achieved quickly and at a low cost. Fees for advisors such as accountants and lawyers should be low. Paper offers. In a paper offer, the target company's shareholders are asked to surrender ownership of their stocks for new stocks or loan stock issued by the bidding company. Mixed offers. Mixed offers of part cash and part paper are made when the purchaser does not have enough cash to pay for the acquisition and is unable or does not wish to raise cash by borrowing or issuing new shares. Paper or cash alternative. An offer can be made giving the target company's shareholders a choice between accepting cash or purchasing the company stocks. A paper offer with a cash alternative can be attractive to vendors because of the choice it gives, improving the likelihood that the bid will be accepted. Deciding on the financing package. The financing of an acquisition from existing cash by issuing stocks, bonds or convertibles, or by bank borrowing has significant implications for the bidding company's financial position after the takeover. Earning per share. An acquisition will have an impact on the purchasing company's earnings per share. On the assumption that the annual income before interest and tax of the purchasing company and the acquired company are the same post-acquisition, there will be either an earnings enhancement, earnings per share will increase, or earnings dilution, earnings per share will fall. Acquisition and leverage. Leverage is the ratio of debt to equity, expressed as a percentage in a company's financial report. When a company has a low level of net assets and needs to raise funds to pay for a cash acquisition, it will try to raise money through a stock issue rather than through borrowing. Structuring a merger. Mergers can be fairly complex structures. An agreement is needed for the corporate structure and stockholding structure of the combined enterprise. Agreements can vary widely, and mergers usually will involve the creation of one or more new companies.